is trapped corporate surplus?
Anytime you want to get it out of the company, that's where you're going to pay.
Moving the funds from the corporation to the personal side.
Most clients, no matter how wealthy they get, they have a fundamental question. They do.
I'll be bringing each week a different guest with all the answers that you have the questions for. And this way you can come back to my podcast for any questions that come to your mind, and you can focus just on working, as everything else this podcast will provide you. Hi, welcome to Simple Wealth Wisdom Podcast. I'm your host, Sim Gakhar. As you all know, I always bring simple financial security ideas for successful business owners and professionals like you to help you build and maintain your lifestyle and legacy. I see a lot of you are always looking for tax advice, accounting advice, legal, estate planning, and investment advice. I feel through this podcast, I can bring all those experts who can answer all your questions that you have in your mind and get a nice advice from them. I'm sure this will add value. And today, I'm very excited to have Mitch as my guest again.
Thanks, Sam. It's a pleasure to be here.
Thank you so much for coming, Mitch. This is the second time he's on my podcast, as a lot of people wanted to hear more from him. And on that request, Mitch is back with us to answer more questions asked by you all. To tell you a little bit more about Mitch, he's trained as a lawyer and he received his law degree from Western Ontario, where he received a special designation affirming his area of concentration as taxation, a favorite topic for all my business owners and self-employed professionals.
Everyone feels they pay too much.
Absolutely. And in his over 20 years in the insurance industry, he's worked for a large insurance company, and he himself has been an advisor, so he truly understands the needs of clients. He takes pride in helping advisors, clients, and their accountants and lawyers. And he truly understands the tax and estate planning benefits of insurance products. So today, we're going to take a deeper dive, and I'm going to ask him the questions that you all requested me to ask. I'm so excited. A lawyer, an advisor, I think somebody all in one behind the products is in front of me, so we can ask as many questions as we want. So, first of all, once again, a very, very warm welcome to you, Mitch.
Thanks.
A second time on my podcast. Thank you so much for coming.
My pleasure.
Let's start from the first question for the business owners and professionals. You know that I am always talking about them. And my first question is, what is trapped corporate surplus? What do you mean by it? And you know what? A lot of people ask the word unlocking it. So what is it?
Okay, well, trapped corporate surplus, from an accounting point of view, accountants sometimes think of it as the retained earnings. I think your business owner clients understand that their first $500,000 of income, they're paying a very, very, very low tax rate on it. If they're in Ontario, 12.2%. And quite frankly, the rate is in that range right across the country for if you have listeners anywhere else. And once you've earned that money, you can move it up into your holding company and invest it. You can reinvest it in the business and really enjoy that low tax rate. But even if you never spend that money in your lifetime and you want to pass it on to your kids, they are going to get hit with a huge amount of tax in order to get it out of the company. Anytime you want to get it out of the company, that's where you're going to pay a huge tax hit and basically bring yourself right up to sort of the 50% overall tax rate on that money. And that's why we refer to that money as trapped corporate surplus. It's trapped inside the corporation. So what do we mean by unlocking it? Unlocking trapped corporate surplus, that's all about unlocking it from the corporate structure and bringing it out to the personal side where you or the next generation, as the case may be, can do something with it.
Wow, you put it so simply. When I was going to ask you this question, I myself was a little concerned that unlocking. So that means moving the funds from the corporation to the personal side And then you are actually making things easier for the next generation.
Absolutely.
Yes.
Absolutely.
Perfect.
That's the idea.
So, why do you think accountants suggest that?
Well, because at the end of the day, it's quite simple. It's a matter of dollars and cents. If you think in not even the short run, even while during your lifetime as an individual business owner, if I've only paid about 12% tax on my money, I have 88 cents left to invest.
Absolutely.
If I take that same dollar of corporate earnings and take it out to myself right away, doesn't matter if I take it out as salary, doesn't matter if I pay the 12% rate and then pay dividend tax on it, I'm going to be left with roughly 50 cents, these days a little less, on the dollar to invest, to spend, to do what I want. So there's no incentive after you've taken out enough money to live and do whatever you need to do. There's no incentive to take that money out of the corporate structure. It makes more sense just to leave it in. You know, my corporate law professor in second year law school, I remember him saying to me, a corporation can buy a boat. A corporation has all the rights and powers and privileges of a natural person. It can buy leisure things. Where you get into trouble from a tax point of view is the company decides to buy a boat and you decide, let's write off the gas because I had a couple clients on the boat that afternoon. And that's when CRA is going to start to look closely. But you can even pay for certain types of personal expenses. You do run certain risks with having taxable benefits charged, but it's very difficult for CRA to track something like that if you're not expensing things from a tax deduction point of view. That being said, really your personal stuff should be personal.
Yeah.
And as long as you're not buying something personal with it, it might not be reinvested in the business. It might be a portfolio type of investment. It might be a piece of real estate.
Yeah.
It might be a life insurance policy, which we're going to talk about. There are lots of things you can do with that money after you've taken out what you need to live on and do what you need to do on the personal side.
Okay, sounds wonderful. So how is there a problem with that then?
Well, look, at the end of the day, I think most clients, no matter how wealthy they get, they have a fundamental question. Why do we do financial plans for clients? It's not just to show them this is what you have. I think the fundamental question a lot of them have is, am I going to be okay?
Right.
Do I have enough money when I stop working to live beyond my life expectancy? I really hope to live longer than that. And do I have enough money that, I don't want to be put into some government fully funded home and be bottom of the barrel. I want to have enough money that if I want home care, I want my family to be able to hire someone.
Absolutely.
If I want to go somewhere nice, great. If I want to take an extra vacation, I have that. But once I've dealt with that and doing a financial plan, I can find that information out very clearly. What most wealthier clients find out is, I've got plenty to do that. And now, what do I do with the rest? Because here's how much is going to be left for the kids. And where we come in with answers is talking about, well, look, you're okay. You've taken care of yourself. You've done a great job in your lifetime. But maybe we can leave more to your kids at the end. Because we already know there's going to be left. And the person person or entity that we're going to be taking it away from to give more to your kids is the government. We're going to pay less taxes. That's always the goal. I think I said this the last time I was on your podcast. Estate planning is all about getting your stuff where you want it to go with as little hassle and as little tax as possible. And that's always what we're trying to do.
That you already answered my next question, which was something like, any ideas for getting the money out and unlocking that trapped surplus?
Well, there are lots of ideas, and the thing is that CRA and finance over the last few years have clued into some of them and tried to put a stop to some of the things around surplus stripping, ramping up things around the general anti-avoidance rule. But we have a product in our arsenal that they're not only not targeting, they actually love that Canadians use, and that is life insurance. It's a different kind of life insurance than your clients are probably used to from when they were younger, because when they were younger, they usually bought term insurance for if they died.
Yeah.
It was all about protection,
Yeah.
covering off your debt, replacing your income, covering off your mortgage, and paying for your kids' education and your
Yeah.
final expenses. But we have products that are for when you die. These are products meant to last for life.
Yeah.
And they're products that will pay your children so long as you pay for them. They are not so much risk management products, but they sort of start to cross that line into almost being something like an investment, because if you pay your premiums, your family will enjoy that money after you're gone. And so life insurance can play a huge role, because we have a whole bunch of special rules in the Income Tax Act that help us deal with this trapped corporate surplus issue.
So that means that most people, what you're trying to say is that insurance is not only for dying, it's for other things that it can do.
Yes,
A lot of people use it just for,
it pays out generally. You know, we're doing this for the payout at death, but it's not to manage the risk of dying. It's to enjoy the tax benefits of the payout when your passing eventually happens. There are the two things that they say we can't avoid, and those are death and taxes, right? Well, yes, we can't eliminate taxes altogether, but we can
mitigate.
Take steps to significantly reduce them, and this is one of those steps.
That is wonderful, wonderful. You know what? Somebody sent me a picture of a restaurant somewhere in downtown Toronto, and the name of the restaurant was Death and Taxes.
Yes.
I'm like, have you been there?
I haven't been there, but I've heard of it.
Oh my God, I
sure.
couldn't believe that.
Yeah, what?
So now I would like you to take a little deeper dive on the insurance side and tell how does that help with the trapped corporate surplus issue?
It helps with it at really three levels as you sort of go along. The first step is that life insurance policies in Canada have the special privilege of creating a tax deferred environment. They are exempt from tax as long as they meet the requirements in the Income Tax Act and the regulations. And companies like us, like RBC Insurance, we not only make sure that our contracts stay within those limits that are set in the Income Tax Act and regulations, we actually go so far as to guarantee right in our contracts with our clients that we will maintain the exempt status of the policy for the lifetime of the policy. Part number two is, now that you've got this vehicle that's growing on a tax exempt basis and does have some cash value that can provide some liquidity if you ever needed to lean on it, either just by withdrawing your own money or borrowing against it, it also pays out tax-free at death. The Income Tax Act is very clear in that it says where you have one of these exempt life insurance policies, a payment in consequence of the death of a life insured is not a disposition of that policy, and it is only a disposition of the policy that could potentially lead to taxes.
Right.
So that's step two. Now step three is that, okay, so now the company bought a policy, the company is the beneficiary of the policy to avoid any taxable benefits.
Right.
How do we get it out?
That's the main problem.
That's right. Well, the Income Tax Act helps us there too. So there is this thing in the Income Tax Act called the Capital Dividend Account.
CDA, yeah.
It's a notional account to track tax-free surpluses received by a corporation. One of the concepts that the whole Income Tax Act is built around is this idea of integration, that it doesn't matter how many corporate entities you have and partnerships and joint ventures and trusts and all these other things. You know, there might be parts of the Income Tax Act that incent certain behavior, like the small business deduction and the low tax rate, but at the end of the day, there's a realization that money has to end up in a real person's hands. And no matter what all those things are that are underneath the person, you should pay the same amount of tax regardless. Now, when you layer that on top of the fact that we consider life insurance to be something that's allowed to accumulate tax-free within limits and pay out tax-free, one of the things that the capital dividend account tracks, death benefit of life insurance policies. Potentially slightly less than the full death benefit in terms of what would credit the CDA, depending on when the client passes away and the structure of the policy and things like that. But most of the death benefit will credit the company's capital dividend account and will allow the new directors of the company to pay out to the new shareholders of the company, so long as they're Canadian residents, tax-free capital dividends with a simple election that any accountant makes all the time. They know about it because it is used in context other than with life insurance.
So that's a great thing. CDA is a very big part of corporately owned policies, and the best way to pass the money to the next generation also on death tax-free from the corporation to the personal in their hands.
You think about it in the early years of a life insurance policy, when you've paid a little bit of premium and the death benefit is a lot. And this is where sort of the rubber hits the road with all this. Because it does provide a little bit of risk mitigation,
right,
in the sense that if I pay a little bit of money at the beginning, there's a big death benefit of the life insurance policy. Let's just take a random number, $50,000.
Yeah.
If I had $50,000 and just invested it, and
even if it's 10-12%, you're making still.
Let's say you passed away, your client got hit by a bus the next day.
Yeah.
Okay. Let's say they did. The reality is there'd only be about somewhere between $25,000 and $30,000 left after tax.
Yeah.
Whereas that, depending on their age, there might be $1 or $2 million of life insurance that pays out.
Yeah.
But you fast forward that out to sort of the range around where life expectancy is.
Yeah.
And if we're looking at clients in their 40s or 50s, and again, depends on policy structure and things like that, we're talking about if you took the same premium stream for the life insurance and invested it in a balanced portfolio,
right,
you're talking about, by using insurance, just because of the taxes that are saved along the way, somewhere between 2 and 3.5 times as much money for their kids in relation to that premium.
The comparison, yeah.
Yeah. I mean, we're talking about a dramatic difference. And it's not an all or nothing approach.
Yeah.
You know, no one says that you have to all of a sudden take all of your money and buy an insurance policy.
It should be.
You need to have liquidity. You need to have easy liquidity to pay for things, to do other things.
Diversification of the portfolio, this should be a part of that.
And this is diversification in a sense. Life insurance is almost like a fourth asset class.
Right.
It's not fixed income, it's not an equity, and it's not real estate. It's something else. It's its own thing in and of itself.
I learned a new word today. It's the fourth class. Okay.
The fourth asset class. Well, you just think about it, and you know more about insurance than your listeners do, but as you know, we're allowed to smooth the returns in the life insurance policy.
Oh yes.
So, to the point that the standard deviation typically of the dividend scale interest rates on every major company's insurance policy in Canada is lower than the standard deviation of GICs.
Yeah.
It's very smooth.
Yeah.
And it's not correlated to anything else as a result, because what we do as an insurance company is we're managing our investments relative to the mortality risk of the pool of people.
Right.
For one. And two, when times are good, we're putting money aside. And when times aren't so good, we're giving that money back to our clients through the dividends in the policy.
Right.
So you have to get yourself in a different mindset as a client when you're looking at a whole life policy.
Absolutely, absolutely. So now, I think that's a very good side of it. Now, how big is the impact of this? I would say, what are we talking about in terms of tax saving?
Well, as I said a couple minutes ago, you're typically, like, for clients between 40 and into their 60s year old, depending on the structure of the contract, relative to an amount of premium that you're paying, you're talking about somewhere between 2 and 3.5 times as much money left to the kids in relation to that. So if we had $50,000 a year going into an investment, and we compared that to the same $50,000 a year going into a life insurance policy, assuming the client's healthy, could be single life on the business owner, could be a joint second to die with the business owner and their partner. There's lots of different ways to structure it, and you know, we work together to figure out what's best for the particular client and works in their circumstances. But you're talking somewhere in the double to 3.5 times as much money. We're talking about serious magnitude. Case I was looking at just today with a 45-year-old client, $60,000 a year for 10 years going into a life insurance policy. For 20 years going into a life insurance policy, right up until retirement. The net to estate from the $60,000 a year for 20 years was about $2.4 million on the investment side. Double their money.
Yeah.
Not a bad news story, right?
Right.
In a balanced portfolio, assuming I think it was around 5.5%. If we took the same money and put it into a whole life policy, the amount that would be left to the kids was $5.8 million.
Yeah.
The savings was almost $3.4 million. Not because the client took more risk to get more out of his money, tax savings. Entirely driven by tax savings, by picking the right structure.
Absolutely. That's what I always tell everyone, even if you are investing it, are you comparing right now with the example that you gave right now, just for the listeners? Is it on the GIC that you compared it to, or did you compare it to 10%, 8% return?
I compared it to a balanced portfolio. So it was a combination of interest, dividends, unrealized and realized capital gains. So it was a portfolio, so there were some deferred taxes. But at death, if you're going to liquidate the whole thing, you're going to pay the taxes at that point.
Huge difference, 2.5 versus 5.5.
Yeah.
Wow. Because they did not do the planning, here the planning was done. Yeah, that's it. You know what, Mitch? It seems almost too good to be true to a lot of people who are hearing it for the very first time. So why doesn't everyone do it if they have money trapped in their corporation?
Well, look, I think there are 3 reasons that immediately come to mind. The first one is your clients are lucky because they're speaking to you. A lot of advisors don't know. This isn't their thing.
Yeah.
You know, they're not licensed to sell insurance. They don't know about the insurance products. I think the second one is that some clients have an irrational fear when it comes to insurance and insurance companies because they associate these types of products with other types of life insurance, with their home and auto insurance, and negative experiences that they've had there. You have to understand that with these products, we do all the underwriting at the front end. And unless there's some accusation of fraud that the client committed, when people pass away, we're in the business of paying death benefits.
Of course.
That is what we do, and we want to pay them quickly. You're not going to wait for assets to pass through probate. I know we talked about that a lot last time. If you've got a direct beneficiary designation, we're talking about once a claim is made, payment to the client within days or weeks at worst.
Yeah. Not
months, not years, no tying anything up in the court. We are going to pay. And I think the third reason that some clients haven't done this is not that they haven't considered it, but they don't qualify medically.
That's the thing.
Not everyone can qualify for this medically. Now, when you work with a good advisor like Sim, the reality is that there might be workarounds even where one client is uninsurable. If there's a healthy spouse or partner, we might be able to insure them. But you have to have an understanding of all those things. But the reality is that not everyone even can do it, even if they want to.
Yeah. So you know what? A lot of time we say that wealth is very important. Here, health is very important.
Absolutely.
You can grow your wealth other ways, but if you really want to use these, the right time is when you're healthy. The right time is now.
Absolutely.
When you're your youngest and you're healthy.
No time like the present, right?
Yes, absolutely, Mitch. And this has been so informative. I loved it. I think
My
you,
pleasure.
I've already requested you to come the second time. You never know. You're getting a call from me to come the third time because you have given so much information and you go really deep into things that it really helps everyone. And I'm sure my audience realizes how powerful life insurance can be when it comes to unlocking trapped corporate surplus. Something very new that you talked about. This word was never used on my podcast.
Okay, great.
So thank you once again. And I really, really appreciate you coming in this rainy day all the way and provide that information to my audience and, of course, to me as well. Every time I learn through my podcast, I learn a lot,
Great.
Mitch, and you've been great. So thank you once again for coming. And that was another episode of the Simple Wealth Wisdom podcast. Please let us know in the comments below what you like the most about this podcast and if there's anything else you want to see or ask, and I'll make sure to bring that to you in our future podcast. Watch us again. Until next time, stay safe. I'm Sim Gakhar. Thank you.